Yes, please go ahead.
Good morning. This is Steve O'Hare from Pia First Limited. Today I'm looking at medium-term trade ideas in both equities and commodities. A brief introduction to myself. Started in the commodity sector in 1987, the Baltic Exchange, and after that moved to the Financial Futures Exchange at the Royal Exchange in Life in London in 1988. Self-employed trading, the German Bund was my speciality from 91, went on my own in 95, screen-based trading 99, ran a prop shop for a while, and nearer to now, 2012, got involved with FX and Pia First Limited, where I work with my business partner Ian Coleman, and Ian specialises in foreign exchange. I specialise in the commodities and equities and fixed income. This year we won a number of technical analyst awards. From the technical analysts, it's a group of experts in the technical analyst field, and we're hoping to do the same next year. And I'm fully qualified in technical analysis through the STA diploma. So I'll give you a brief rundown of what we're going to do. We're going to look at the medium-term equities first, then move on to commodities. Feel free to ask questions as we go along, and I'll try and answer them as soon as it's relevant, or as soon as I can, and then we can try and make it a little bit interactive, this webinar. So any questions pop up, just type them in the chat, and I'll answer when I can. So what is a trade idea? A trade idea is based on sound technical analysis, using a good risk-reward strategy to try and take advantages of differential in prices, movement in prices over short, medium or long term. We're concentrating on the medium term today. As a rule, Pia First supplies daily trade ideas in over 20-25 products on a daily basis, and but we also look at the medium term to get our shorter term trade ideas and levels. Now, risk reward is very important in these trade ideas, and we concentrate on that. And I'll quickly go over to my charts, show you our charts, show you how we work out our trade ideas over the different time frames. So bear with me 1 second. Screen share my chart package. Chart package I use is Saxo Trader. It's a pretty good one. Right, and as you can see, here we are. We're looking at the DAX first of all. This is the long-term chart. This is a weekly chart on the DAX, and I'm showing you a line chart. Now, a line chart is different to charts that you may see on a regular basis across all the forums. Candlesticks charts are one of the more popular nowadays, and they are popular because they give you a very good indication of what has happened in the market, formations that are taking place, and so on. But for a long-term outlook, the medium-term charts the medium-term and long-term charts, line charts, are very important. What they do is they take away the tails, so they take away the spikes in prices, and they concentrate on the closing price of the bar, or the day, or the week, or the hour. So a line chart will look different. If I plot now a candlestick chart, you'll see that the lows that we had drawn from the line chart have been penetrated by the candlesticks. So that's what we call noise in the markets. The most important price that traders look at is the closing price. So that is where buyers and sellers have come together, traded on a daily or weekly basis, and are satisfied that that is value of the product or the asset at that point in time. So the close is a very key price to watch in any chart. So if we go back to the line chart, this shows that the DAX, the German 30 index, from a Saxo perspective, remains in a long-term uptrend. This goes back to 2011 and even further back to 2009. Now we can see, if we scale in the chart, a couple of key levels, a couple of important levels within the DAX chart. One of the main ones from a long-term perspective is this high in 2000 and a high in 2007, 2008, which is around about 8,000. So that is a very key level. It capped the market twice over the long term, and it's maybe something that we will see in the future when resistances are formed or supports are formed, and then that resistance is then broken by price. It can become a support level, and it's always good to look at the longer term charts to make sure that we are aware of the longer term levels, because they can play quite an important role in a short term trade idea or short term trade perspective. So we'll leave that level highlighted around about 8,000. Now, if we you can see I've got some Fibonacci lines drawn in. I can also draw a nice Fibonacci retracement here. And Fibonacci retracements are very generally pretty good targets to look for. And we can look at, there's two or three key ones. An initial retracement, we look at, let me get rid of a few of the lines so it will give you more of an idea. I'll take the 50% out. 38% is a normal retracement from an uptrend or a move up, and we can see here that the last big leg up from 2011 to the peak in Q1 2015, we've seen a 38.2% retracement down to 9,500, that area. Market reacted off here and has rallied, but this rally has recently turned again. So, and from this, we can see that the prices are now back heading towards this uptrend line, which is a key uptrend line. An uptrend is, or a downtrend line is considered valid when it features at least 3 points. So you'll have the starting point, and it will test a support a second time and a third time. On the third time, then it's classed as a valid trend line. So here we had an up move. It was tested once, tested twice, third time reacted here, fourth time here. So we're looking again at attacking this from the upside. So although we are in a uptrend, we believe that there's plenty of scope for a further retracement to the downside in the not too distant future. One of the other major Fibonacci retracement lines is 61.8% Fibonacci retracement line. This comes in at 61.8, 7,850. So it's not far away from the 8,000 long-term level that we were talking about. And I would consider that a long-term target, especially if price action fails to extend above this high in Q1 2015. If it fails to extend above that in the upcoming months, then I wouldn't be surprised if we revisit this 61.8% level. So again, we got the rally on in November, peaked, capped out here. This is a potential trend line, and we would look to now be setting shorts in front of this area. A stop can be placed above this peak, and we would look to be targeting the 38.2% retracement. Also a low here, 8,765, on the way down to 8,000. So that's one trade idea, more of a medium to long-term trade idea. To actually get into the trade idea, obviously you want to try and break the chart down even further to a daily chart. And we do this, and this is where we do use candlesticks, because candlesticks can create some decent formations. And we see formations being replicated on a continual basis, and these formations can then project targets and areas to focus on. Now, I also included Ichimoku Cloud within my analysis. This again it paints a really clear picture of where upcoming support is, and whether we are in an uptrend, a downtrend, or going sideways. Now, we go back to the peak 2015, sell off to the 9,300 level, and the rally back to just shy of 11,500. And now we're seeing this sell-off since late November is pretty much in full swing. We saw Friday develop into a bearish engulfing candle, where the open has opened higher than the previous day's close, and prices have closed lower and engulfed the body of the previous candle. So although this was a green candle where prices have opened and closed higher, it was still wrapped up within a bearish move. So this there shows no signs at the moment of any slowdown in this sell-off. Now, we'd like to give a trade idea, and we'd like to obviously point out the high, a break above this level, and we're looking at another move up. So really stops above 11,500, getting short in front of here, targeting 9,300. Quite straightforward looking move, but obviously it's been a mixed and volatile year for equities, so you have to sort of expect the unexpected to a certain extent. But as long as you have a good risk-reward approach, be consistent with your approach to trading, then the chances are you're going to make more profitable trades. It's very easy to have a couple of losing trades on a system or a methodology that you've used for a period of time, and become a bit disillusioned, complacent with that, and start changing things. That's one key thing to remember. When you find a system or approach that works on a regular basis, you've got to do your best to stick with it. So we're bearish of DAX. Now we'll take a look at FTSE. FTSE's a slightly different animal to DAX. Again, we'll look at the weekly chart. This weekly chart is a slightly different formation. We can see that we had the upward trending channel from 2009. We had a couple of points here where it's supported. And 2014, FTSE actually broke below that uptrend line, and that threw the market into a sideways trending formation. Now, if we look at it, it looks like an expanded wedge formation, which are notoriously difficult formations to trade. And over the last few days, that expanding wedge formation has broken the lower supporting trend line. And this is a key time for the FTSE, basically. We have to, if you look back, you can see that the previous resistances around about 6,100 have been breached as well. So it's really under pressure, the FTSE. So again, we're looking at, from a medium-term perspective, to be setting up shorts going short of this. Now, if we break this down onto the daily chart, from the line chart, again, we can see how the market is under a lot of pressure into the month of December. We can add some trend lines to give us a bit of a clearer picture. And we can see that this candle on Friday, actually is another bearish candle. It's the fifth bearish candle on the spin. And it was a Marabuzzo candle. A Marabuzzo candle is where the market opens at an extreme point, at the high or the low, and has a one-way move and closes at the extreme of the day. So if we open on the high and selling comes in and the market pushes down, pushes lower, and we get to and we close at the low of the day, or adversely, if we open at the low, rally hard, and close at the high, both Marabuzzo candles. Marabuzzo candles can give you a good level, like usually a 50% retracement of that Marabuzzo candle acts as support or resistance, depending on whether it's a bearish or bullish candle. So Friday's was a bearish candle, and resistance was would be 50%, a 50% move of that pullback of that candle. So that's, let's have a little quick workout on the so we had 60.83 was the open and 59.22 the close. That's 161 ticks divided by 2, which is 80 ticks, and you add that to the close. 59.18 plus 80. That brings the Marabuzzo level in at just under 6,000. Now today, prices have rallied higher, opened strong, pushed higher, and have stalled and reversed at 6,010. So that Marabuzzo has held so far. So that again keeps the pressure on the FTSE from a medium-term perspective. I'll be more inclined to try and look for a little bit more of a pullback to set in shorts. So you want to basically be setting shorts around about where the highs were on Friday, around about 6,085, 6,100. From that perspective, then your target would be a move down towards the August lows, 5,767. We'll look for another target. We have to look at a slightly further support. That support comes in at the low, horizontal support at 5,600. And let's even bring in some Fibonacci retracement levels to be aware of. Be better to put this on a weekly chart. So we're looking at 61.8% retracement as 5,680. So that again coincides with this horizontal support. 78.6, 5,290. And then for 4,788 would be an eventual target. Now, at the same time as having a retracement, we can also look to Fibonacci extension levels. Extension levels are built from a peak to from a bearish perspective we're talking now. So the peak back here, this is why these charts are great. They're very easy to use, like a lot of packages nowadays. And very quickly we can build up a Fibonacci extension targets where we've taken the peak to the swing low, the retracement back, and we're targeting 5,400. 127.2% extension is a very popular one. The 161.8 is much more popular. Again, this brings us down to around about the 5,000 area. So from a medium-term perspective, we'd look to set shorts around about 6,100. Have the stop above here, maybe even as high as 6,300. So we've got a 200-point stop there. So obviously our target has got to be at least the same, preferably double what the risk is. So if we've got a risk of 200 points, our target ideally wants to be about 400 points. So a break of this support back in Q3 2015 in August, and we expect at least a move down to 5,400. That's a 700-point target against a 200-point stop. It's a 3.5 to 1 ratio, which isn't bad. So that's what we're looking at in FTSE. I'm trying to find my chat screen. See if I bring it up. Yes, I can see it. If you do have any comments that you'd like to make or interjections you'd like to make, let me just try and bring up that's okay, a chat facility so I can see you asking the questions. Now we'll look at I'll look at CAC before I look at Dow and S&P. CAC again, this is the long-term chart. We'll move it to a line chart. And you've obviously got different trend lines that I've drawn over time. I'll remove them, start again. You've got this trend line here that we're very keen on looking at. This will be a long-term trend line. A more nearer-term trend line would be, let's bring this up, the 2012. And get rid of all these so it's a little bit clearer. So this trend line from 2012 has found support 3 times. That confirms the trend line the 3rd time. This is the 1st, 2nd, 3rd. Since then as well, 2015 has seen us test this uptrend line twice. Even on Friday, we tested it again. So this shows that the CAC is in a similar position to FTSE, although at present it's held the trend line, whereas the FTSE has broken it. So it would be no surprise to see the CAC breaking that in the next few days. Again, this will be quite a key break because you can see from the resistances here or the peaks here, previous resistance becomes support. So a clear break of this area we should expect quite an accelerated downward move. So again, prices are at key pivotal levels, and we'd look to set shorts on a break of these key support levels. So while the DAX and the FTSE are looking to sell into rallies, a play from the CAC point of view would be to sell a break. And we'd probably look to sell a break of 4,450 area. But again, we want to get a more specific trigger, so we'd have to break it down onto a smaller time frame chart, because obviously, as I said before, these line charts don't give you the extremes of the moves or the highs and lows that you necessarily see. So from here, it looks like the low is 4,447. You look at a daily chart, and you can see we've been down to lower than that. It shows you how not how misleading it can be, but how these closes on a line chart can, or the moves within a month or within a week can be quite large. But then, as we said, the most important thing is the closing price. So that would be a key thing to watch, so close below this trend line. So, or you know, you look at it, a weekly chart, you have to wait for that Friday close before you enter the trade. So sometimes you can miss that, the ideal point of getting into a trade, but that's the risk that that you take. If you want to be a bit more risky, you try and get in a little bit earlier. So we would look at this, and the trend line is clearly showing up down at this level at the moment, 4,300, and up until the end of December, 4,385. So it looks like we are heading that way. Looks like we're, we've had a very bearish start to the month. Things are expected to quieten down, and this will remain under pressure again, and maybe looking to target a break of this uptrend line into January, into the new year. Quite often there are big moves in January. It's the end of the year. A lot of funds, banks, and big traders like to close their books, get flat coming up to Christmas time, and then they take their view on the year and enter their trades in January. So again, we're looking to set shorts on a medium-term basis, either on a break and a close below this uptrending line, or even if we do get a pullback into the late part of December, early January, we'd look to be setting shorts in front of 5,100, which would be a confirmation of this downtrend line. So I'm painting quite a bearish picture on equities at the moment. I'm sure there'll be plenty of people who disagree, but this is what the charts, this is how I'm interpreting the charts. Now, we'll pop across the ocean, the Atlantic, to the States, and have a look at the Dow Industrials and S&Ps. Dow Industrials, we were in a bullish trend channel, 2009, and there's no real signs of this changing anytime soon. So you can see the sort of disparity between what we're seeing in Europe and what we're seeing in America. And this can probably be linked to the economic cycle, the differences in the cycles of the continents and nations, where you have the Fed and a sort of heavily anticipated meeting this week, where they're talking about raising rates, And you have the adverse on this side of the pond, where the ECB and Bank of England are looking to cut rates or maintain rates at record lows, add more QE, quantitative easing, which, you know, even the threat of that would normally give a boost to equity markets, but these threats or these boosts, or even the action that they're taking, you know, most recently the ECB, doesn't seem to be having the effect that the ECB would like. A very confusing resulting meeting last week, and the markets have been hit quite hard recently. So you've got two different and opposing pictures forming. So at the moment, this bullish trend channel looks intact. We've obviously got the cloud is on, prices are trading within the weekly cloud. When prices do trade within the Ichimoku cloud, between this is a supportive area at the moment. This is the bottom of the cloud. The top of the cloud is a resistance area, because we're trading in the middle. So this will be key to watch, because for such a long period of time, the cloud has acted as a great support line for the Dow. Prices broke lower in August when we had the big equity sell-off, but then a lovely bullish hammer candle formed on the weekly chart of the Dow. This is a bullish signal, and it shows that prices clearly reject a significant low and actually closed higher on the week. So that stemmed the flow out of US stocks, and buyers took a few weeks, but managed to regain confidence and come back in. But presently, they've been unable to maintain levels above the cloud resistance. So although we're looking at the Dow and we're seeing attempts to sort of build higher, they seem to be failing at the moment. So it still remains under pressure, but there's plenty more support below to stem any selling that's taking place. So this is a bit of more of a mixed bag at the moment. You can take both markets. You can take the Dow against an equivalent type of product in Europe, and you'd be selling Europe, buying US. So if you wanted to have a hedge trade on, and you wanted to be involved in equities, you can be buying the Dow and selling an equivalent. So say selling the Euro stocks, and that is basically more of an exchange trade, but also not just an exchange trade, because one would be in euros, one would be in dollars, but also it's an outlook of the economy. So it's like an economic hedge, if you will. So we can give a trade idea in here. Probably our confidence level wouldn't be as high because it is mixed at the moment, but we'd definitely be looking to break this down on a more short-term basis. And we can see I highlighted a little while ago this congestive area around the 17,100 level. We have also highlighted an ABC formation, which would be targeting on the bullish side, targeting in a move to 18,700, but also quite close to a double top formation. Now, a double top formation is where prices have achieved a similar high or a similar, well, we'll talk about the double top because this is relevant, a similar high and a dip in between. So we had the high on the November the 4th 17,975, and we've had similar highs on 3 or 4 different occasions, 17,915, and then we had this dip in between down to, I'll just take out this, down to 17,092. Now, if we take the measurement between the highs and that low, if we break this low, then that will form the double top. It won't be formed until then. It's not a double top until it breaks this, we'll call it a neckline. So our outlook on this would be to sell a break, to trade a break basically of this pattern, because we're looking at the ABCD formation. We're also looking at this double top formation. So if we do break 17,092, we'd be looking to set shorts on a closing basis, and we'd be looking to target 16,237. This is just obviously in front of the big support around 16,000. Now, on the other side of the coin, if prices do manage to break above this downtrend line, we could see the extension higher, the ABCD formation, targeting a move up to 19,000. That's pretty extended move. So that's it's more of a trader break on the Dow. It's not just bearish like I am with the European sector. The US sector definitely has far more support in it. So hop now to S&Ps. Again, we've got a line chart on the weekly chart of S&Ps. This is going back to 2009. We've got the first point, 2, 3 points. Could class it, that's the point as well, maybe 4. And if we look at maybe the 2011 move, again, you're looking at another trend line that is in from 2011, and we could sort of definitely see this acting again as support, but a break of these trend lines, and it will immediately be targeting the bigger trend line. So the S&P's currently trading at 2010. I've got this, let me get this onto a candlestick chart. Again, this is this, if we go back to the August lows, that point there, and then we see a double bottom. This double bottom was targeting 2,150. It's not quite a classic double bottom, obviously, because these have big lower. But obviously, look at, if you take the tails out and look at the closing price, it's more of a double bottom. Let me just look at that. So that's more of a double bottom. That's more like it. So 2,120 was the real target. And we failed just in front of there, 2,116. So again, let's reverse it backwards. I don't want to be all too doom and gloom about everything, so I will give an opinion from both sides. And again, get the line chart back up. We'll call that a double top. $19.44. So a break and close below this level here, which we're at now. You take it back to the candlestick chart, and this is where you really want to be getting in. You want to be getting in on a clear break below 2000. 2010, you know, and if we break 2000 as well, the cloud support is under pressure straight away. So there's definitely things, although we come up to Christmas time, which is normally a quite quiet period, there looks to be opportunities sitting around about where we're trading now. So I would be very aware of these levels and look to be taking advantage over these quiet periods. The problem with quiet periods is sometimes the actual liquidity dries up, but on these major exchanges, that shouldn't be too much of a problem for most of us. So yeah, I can see we've had the daily move today. We've already been quite aggressive on the up move. We stalled at 2030 and we traced 20 points. These are quite big moves for the S&Ps. From an average point of view, this gives you an idea. The 10-day average true range for the S&Ps is 35 points, and we're up to 20 points already today. So if we do manage to build a bit of bearish momentum, we could see this market breaking lower, and then we'll be targeting around about the 1950 area. Let's get a Fibonacci line drawn. That would be around about the 50% of the August November up move. Further targets would be 61%, which is 1940, and 78.6% retracement 1895. So again, watch that. It seems to be in motion as we speak, where we're seeing the S&Ps coming under pressure. And in fact, quickly jump into my live prices is happening at this point. So quite exciting live move we're seeing here. On a short-term basis, I'd be looking to sell a break of 2007. You know, so we're close to that now. So even at 2002, we could get, you know, even on a day trade, I'll be looking to sell a break of Friday's low. Targets can be set at 1990, this horizontal level. Nearer term targets 2003. So you know, it depends what you're looking for. Short term, medium term, long term. You know, it's all relative. So now we'll have a quick look at. I realise I've waffled on a little bit. We will have a quick look at commodities. Oil is the buzz product at the moment, along with gold, due to the US dollar pricing of the oil and gold. And we've been bearish on oil for a long while, and you can see from this line chart back in 2014 the break here of $90, and everything was projecting lower. That's where we would be. We're targeting when we $55 when we broke this level. That's just the move that we expected from that formation. A symmetrical triangle formation. So we've had the big move down, which found support around the mid to low 40 area, and more recently at $40, just below 39.85 was a key support. It's broke that, and there's nothing or not a lot in the way of support between there and the low in 2008 at 33.14. That's on a closing basis. 32.50 is probably more of an official target. Very close now. Again, in oil, where we're looking at, you know, the previous supports, which look to be, so they act as resistance now. That's around about $40. So we're selling any rallies towards that area, and we'll continue to do that even into the new year. We provided a piece of analysis last week where we're looking to sell levels up to 45 bucks in oil. Stop would be a tight stop would be a break above $50. The targets on the trade were 32 and even $22. Now the $22 is an extension, Fibonacci extension target, and well, I can show you it there. $22.59, and that's taking the May high, August low, and extending on from there. So initial target's $31 here. Obviously, on the longer term basis, we go back to 2008, and that's the initial target. So bearish of oil. Gold. Gold is again a similar type of outlook. We've been bearish on gold for a long while. It still seems to be trending downwards towards the psychological level of $1,000. I expected to get there. I expected to break $1,000 as well. Before, you know, we sort of, I mean, it was for a very long period of time, it was a safe haven asset. That's lost a little bit of its appeal. Although when we do get breaking news stories that have a sort of detrimental effect to economies, the first thing people turn to is gold. But the rallies that we've seen in gold over the last couple of years have had less power and have been more short-lived. So these snapbacks that we get don't seem to last long, and the appeal of gold, it has drained away. Now, the one on the plus side for gold, we see an ending wedge formation, which looks bearish, but in fact it is a bullish formation, a potential bullish formation. So we're always aware of this, and I think if this ever did break to the upside, that's when gold would really become the key safe haven asset that it used to be. But I can't see really anything in 2016 which tells me that we've got to worry about the upside for the time being. So gold, again, we're looking at the horizontal level around about the $1,200 mark. That would be a great place to have a stop above there, which would also relate to the downtrend line of the ending wedge, which would be broken. But really, we're looking to sell rallies in front of here up to 11,000. 11,055 was a great Fibonacci level, and this is from the 2008 rally to the 2011. 61.8. Looks like we're heading toward the 78.6, which is at $946. $946. So again, we're bearish of gold, but we wouldn't be looking to set shorts at these levels. We'd be looking to sell into rallies. If you were really desperate to get short of gold, you'd have to look for a close below 10,045. And the main target on that again would be, there's some horizontal lows which you can pick out, but $1,000 is the real level that we're looking to target before 946. So bearish in gold. Silver seems to have broken recently. it was holding around this $14 level for quite some time. Had a decent reaction back in back in two weeks ago, 4th of December, but this reaction higher failed instantly, and since then we've broken through the $14 mark, and we're heading to 13.40 and even as low as 12.25. So I mean, has anyone got any questions? I'll try and I see a question from Pan. Do you correlate this to yen crosses to and expect yen strength? Well, Ian deals with the yen, so it's very difficult to. I know what you're saying about the both equity and commodity markets and the yen strength, and there's things going on in Japan which you have to be aware of as well. Obviously, everything seems to be the boom seems to be struggling. But yeah, so you can actually link it to that. But it's what I like to do. I like to keep everything separate rather than correlate too many markets. Try and keep things more simple. And you know, what I'll do, I'll bring the dollar yen up and show you for a similar. Let's bring dollar yen against. It depends what you want to. If you want to look at it against the equities or the oil, we'll look at it against the oil. We'll add that in. And now you can see the correlation. It's obvious there. It's more the sort of like the dollar correlation, and you can see the extremes it's reached. And you expect some sort of pullback. I mean, we can see how the markets have correlated over the years, going back to 2000. For whatever reason, the oil contract Saxo doesn't extend further than that. I'm sure oil was about before then. But yeah, and then we'll even link it to the equities as well. Let's have a daily chart. Maybe better to have line charts. Now there's too many lines. Let's get rid of the cloud. Let's get rid of the fibs. And you see how dollar yen's tracking the equities pretty closely. So I think the dollar strength has an impact on this, and it's always one you've got to be aware of. Dollar has always been classed as a safe haven asset, but with the different economies going in different directions, you've got to be very careful with that. As I say, I'd rather keep it slightly more simple and analyze each product individually. Sometimes you'll get an obvious sell signal or buy signal in one product, and it won't be as obvious in a correlated product. So it's good to sort of like approach every different asset class with a real more simplified approach. Make things too complicated, and it's very hard to get any type of confidence or any type of consistency, because the complicated things can have so many different inputs. Let me just double check that. Yeah, you usually correlate with stocks. Very confusing messages from Japan. Yeah, I mean, Japan are a bit of a law unto themselves in a lot of ways. So we will try and, as I say, keep it more simple. So with an outlook of mainly bearish in stocks, you can see how the dollar yen is linked to that. You know, yen strength. So yeah, let's quickly move on. Anyone else wanted me to analyze any other product very quickly? What is the scenario for rate hike in Wednesday, and what if no rate hike? Well, I can't predict what they're going to do. There's an expectation of a rate hike this Wednesday from a number of fields. Therefore, if no rate hike is to occur, that will be a disappointment for market expectations. So if you link that back and you apply it to, I don't necessarily think it'll have a major impact from a short-term perspective, or sorry, from a more medium-term perspective. The more medium-term perspective will factor in expectations in the market. Prices will factor them in. Now, if there is a shock at the rate meeting, then you'll have a short-term reaction to that. But that short-term reaction will then dissipate quite quickly, because if they don't hike rates, and they're talking about it on Wednesday, then people will start thinking, they haven't done it this month. What about next month? What about the month after? So it's a case of obviously timing of when they do it. It will happen eventually. We know that, but it's obviously the other questions are, what will they do? How much will they do? Will they do it? So it's you'll get the real short-term impact, but it's good not to sort of be involved in them short-term impacts in the market, and then look to analyze the markets very quickly just post the meeting. And then by the time we digest the information, it's you'll start to sort of like, the market should be back to where it was, and start to consider more of the medium-term outlook. So yeah, there will be you'd expect some reaction, but it's a nice time to just get flat, sit aside, or if you've got a position that's well on side, just make sure you manage it well. But things are priced into the market. We look at it from a technical perspective. Technical analysts believe that everything's considered, that is known. So we know there's a meeting, we know there's an expectation. Any sort of any difference to that, then yeah, you'll get the reaction, but it will be quite short-lived. So I think we're out of time now. I hope you've enjoyed today. I'm more than happy. I won't see you now until January. We've got a couple of week break. Good luck with everything in the interim period, and I look forward to January and digesting what's gone on over that period, the Christmas period, and look forward to speaking to you then. Thanks very much.